The correlation has been quite good recently. There was a time when it wasn't. But ADP has a very large client base. I think this means tomorrow the number will be larger than people had expected. 250 is not a bad guess. And anything larger than consensus, you're going to see the market go up, but you're also going to see the 10-year bond yield go up a little bit too. So I think we break 17,000 tomorrow.
Okay, now, of course, the Fed has taken great pains to, communicate how frustrated they are at the slow progress of the improvement in the labor market. Do you think that the market players there are going to be sort of pricking beneath the surface to look at the details of this report, as they normally do, to see whether sort of the U6 rate might see a better improvement rather than the U3 rate in terms of unemployment?
The big unemployment story is that long-term unemployment is still very high and going to remain high because about 5% of people have actually left the labor force or permanently lost their job. But short-term unemployment's actually come down quite low and is near average, and that's the one that works for things like tightness of labor markets, wage rates, and the like. So I think we're starting to see more and more stories about inflation. To your point about the Fed, it's very interesting the Fed's so frustrated because it's the regulations that came out with Dodd-Frank that actually have made this number so slow. Big banks have actually been lending, but little banks are dead in the water, and that's because their compliance costs are so high. Without small banks loaning to small companies, you can't have big job growth numbers.
Right, John. That brings us to the point, as to when the sort of crossroads, we had a crossroads, for interest rates in the United States. And when do you think that the bond market is going to finally start to price in an improving U.S. economy, notwithstanding what number we get out from the NFP tomorrow?
I think that that's the bet to make right now. We saw what's interesting about the last 12 months' numbers is that almost everything has gone up during that time. Different markets, different sizes of companies, small, medium, large, different sectors, everything's up double digits. At the same time, the VIX is at 16-year lows for volatility. So there's a big event that's making people have the same opinion. That event is central bank policy, and it is gradually working its way in through loans. It's shown up in the asset markets first. We're now seeing stories about labor market tightening and skilled labor shortages. So the inflation story is going to quietly and gradually replace the disinflation or deflation story in the coming months. I think the bond where it is today, up to 262, I suspect that the next stop is 3%. If I had to make a bet end of year, I think 3%, 10-year bond's not a bad bet.